When it comes to managing your money, there's always a balance between risk and reward. You've probably heard the phrase, no risk, no reward. But does that mean you should throw caution to the wind, not worry about the consequences? In this video, I want to break down how taking financial risks can impact your future, and why sometimes playing it safe is actually the riskiest choice. Imagine you've got two options: play it safe, stick to what you know, or take a leap of faith and see where it takes you. To some, that can sound like a risky choice, right? Well, that's what we're going to talk about in this video today. How making decisions that involve risk can shape your financial future, and why it's not always about playing it safe. Let's go. Before we dive into the details, let's figure out what risk and reward actually mean in the world of personal finance and money. Risk is simply the chance that things won't go as planned. It's the possibility of losing money, failing, or facing uncertainty. On the other hand, reward is the potential benefit you could gain if things go well, whether it's financial growth, personal satisfaction, or hitting a major milestone, a major goal. Now, here's the trick, and in most circumstances, this rings true, though not in all. If you invest in the stock market, for example, your investments could skyrocket, your whole portfolio could go up a ton, but it could also take a dive. It can sound like the ultimate gamble, but with the right strategy, it's one that can pay off big time. Not all financial risks are the same. There are different types of financial risks, and understanding them is the key to making smart financial decisions. Let's look at some common types of financial risks, and we're going to look at 5 here. Firstly, there is investment risk. This is the risk you take when you put money into things like stocks, bonds, mutual funds, ETFs, that kind of thing. The value of your investment can fluctuate, and you could end up losing money if you sell when the market goes down. Then there's credit risk, number 2. If you borrow money, like taking a credit card out or taking a loan out, then there's always the risk of being unable to repay that debt. Failing to repay on time at the right intervals can affect your credit score and your financial future. Then there's business risk at number 3. Starting a business is a classic example of taking a big financial risk. There's always the chance your business won't take off as planned, which means you could lose money you've invested in it. At number 4, I'm going to talk about liquidity risk. This refers to the risk of not being able to turn your assets into cash quickly to avoid losing value. For example, property can take time to sell. So if you're invested in property and the property market is crashing, you can't get rid of it today at a snap of a finger, which means it's inherently less liquid than cash or stocks. At number 5, there's inflation risk. Everyone always talks about inflation in terms of prices going up and everything getting more expensive. And in one sense, that's right. Of course it is. We all know that inflation is the increase in the cost of living. But even though we all talk about it, it's largely a hidden risk that erodes the purchasing power of your money over time. Even if you think your money is growing, inflation could outpace your gains. Let's say you're earning 2% on your interest in a cash savings account. If inflation is running at higher than 2%, let's say 3, 4, 5%, then inflation is eroding the purchasing power of your money. I've talked about this in another video, which I'll link to somewhere over here. This kind of impact of inflation can sometimes feel you're running on the spot really fast, at pace, but not getting anywhere. Each of these risks plays an important role in your financial decisions. Whether you know them or not, whether you understand them or not, they are there. But it's important to weigh these risks against the potential rewards so you have the full picture, and that's what we're going to talk about next. So we've covered the risks, but what about the rewards? After all, it's the reward side of the equation that makes taking risks worthwhile in the first place, right? I'm going to break these into 5 parts as well. Number 1 is wealth building. Perhaps the biggest reward for taking financial risks is the potential for building long-term wealth. Investing in stocks, bonds, mutual funds, ETFs, cryptocurrencies, gold, or even property offers the possibility of earning higher returns than cash left stagnant in a savings account. Over time, these returns can compound massively and significantly grow your wealth. At number 2, there's the opportunity for growth. Risk-taking isn't just about money. It can also lead to personal growth. When you take calculated risks, whether it's with investments, starting a business, or buying property, you develop new skills and learn from the experience. These lessons can be invaluable for your personal growth and for your financial future, even if the initial financial outcome isn't the one you hoped for. Number 3 is creating passive income. Yes, I said it. Those 2 words that have long been the dangling carrot that financial gurus online will talk to you about. One of the ultimate rewards of taking financial risks is the opportunity to generate passive income. Investments such as stocks that pay dividends or real estate, property that generate a rental income can generate money for you as you sleep. That part can be true, of course, but it's not entirely passive. But it's certainly more passive than earned income, where you go to a job 9 to 5 to earn your money. Sometimes I like to call passive income almost passive income, because that's what it really is. This almost passive income helps you diversify your income streams so you don't have to rely on the traditional solo paycheck. Number 4 is building financial security. While sometimes it might sound counterintuitive, taking some calculated financial risks can actually improve and give you financial security. By building wealth through investments and business ventures, you're laying the groundwork for a financially secure future that's less dependent on income from just one source like a job or a pension. And at number 5, retirement goals. Taking financial risks, particularly through long-term investments, can help you reach your retirement goals faster. By putting your money into riskier assets like stocks, bonds, mutual funds, or ETFs, you have the potential for greater returns, which can help get to your retirement targets much faster. Now, of course, it's important to understand that the rewards aren't guaranteed. They need to be weighed up against the risks. And if you take anything away from this video, it's that don't focus too much on the risks, focus on the rewards as well, take the rewards into account as well. And equally, if you're the type of person that focuses too much on the rewards, then take the risks into account as well. Just doing one or the other isn't a good strategy. So while these rewards aren't guaranteed, with the right planning, with the right education, and with the right strategy, they can be worth the risk. So now you've heard about risks and rewards. So the natural question that follows this is, how do I manage my financial risks? So let's learn how to manage those risks effectively while still pursuing those rewards. And you've guessed it, there's 5 things I want to talk about here too. Number 1 is diversification. Don't put all your eggs in one basket. Not that I know anyone that puts eggs in baskets these days. But that saying isn't meant to be taken literally, right? It means spreading your investments across different assets. Stocks, bonds, property, crypto, whatever it is. And this is to reduce the risk of one single bad investment wiping you out. Say one asset class falls completely, everything goes to pot. Then you're still left with enough cash, enough investments in all of the other assets to make sure that you're not wiped out. You're still okay. It's like not betting your whole paycheck on that one horse at a race. Number 2, do your research. The more you know about the risks involved, the better decisions you're likely to make. Whether it's picking stocks, buying property, or even choosing the right insurance, make sure you're informed about what could go wrong and how you can protect yourself. Number 3, start small. If you're just starting out with investments or making big financial decisions, begin with smaller, less riskier moves. This gives you time to learn without risking everything right out of the gate. Number 4 is an emergency fund, or what I like to call a contingency fund. Life happens and can be unpredictable, so having some cash set aside for emergencies can help you manage risks without worrying about going into debt if things don't go to plan. Number 5, set clear financial goals, and you'll hear this one a lot, not just from me but from others too. And it takes a bit of getting your head around because we're not used to making goals for our money. All we know is we want more of it, right? But knowing what you're working towards, specifically what you're working towards, can help you stay focused. So you're not just taking random risks for the sake of it. And remember, not doing anything with your money, not knowing what to do with your money is also a risk. It's kind of captured in the inflation risk that I mentioned earlier. Clear goals can give you that roadmap, and then the risks you take will have a purpose. So what's the takeaway from all this? Risk and reward are 2 sides of the same coin. Yes, of course, taking risks can be scary, but it's also the path to financial growth and achieving big goals. But just to drum the point home, not taking risks, not doing anything is in itself a risk too, even if it doesn't seem that way. By managing your risks, doing your research, and staying informed, you can take control of your financial future whilst minimizing the risk of a big setback. If this video helped you understand risks and rewards that little bit better, or even a lot better, then hit the like button and make sure you share it with the people in your life that could benefit. You never know how that simple gesture of sharing it on your socials could help someone. And if you want to continue your own money basics journey, then make sure you watch this video next.